Hello investors, welcome back to the channel Stock Market Analyst. Today we are diving into one of the most talked about ETFs, the YieldMax NVDA Option Income Strategy ETF, ticker symbol NVDY. With a jaw-dropping 80% plus dividend yield, this ETF has attracted income investors, options traders, and Nvidia bulls alike. But is NVDY a smart play or a ticking time bomb? What is NVDY? NVDY is an actively managed ETF that uses a synthetic covered call strategy on Nvidia stock, NVDA. Instead of holding NVDA directly, it uses flex options and cash collateral, mainly US Treasuries, to generate income. The goal? Maximize current income while capping upside gains. It's part of the YieldMax ETF family, which includes similar strategies for Tesla, Apple, and other tech giants. NVDY launched in May 2023, and as of November 2025, it has $1.85 billion in assets under management and 108 million shares outstanding. Performance and yield, let's talk numbers. But the real headline is its trailing 12-month dividend of $13.03, which translates to an 80.41% yield. That's not a typo. NVDY pays weekly dividends, making it a favorite among income-focused investors. However, this yield is not guaranteed and depends heavily on Nvidia's volatility and options premiums. How NVDY works? NVDY doesn't own Nvidia shares. Instead, it uses call and put options to simulate exposure. The fund sells covered calls to generate income and uses cash collateral to back the strategy. This means 1. You won't benefit from Nvidia's full upside. 2. You're exposed to decay and volatility risk. 3. The ETF thrives when NVDA trades sideways or slightly bullish. It's a derivatives-based income strategy, not a growth vehicle. Risks and drawbacks. Now for the risks. First, capital erosion. NVDY's price has dropped over 30% from its peak, even while paying high dividends. That's because the ETF sacrifices upside for income. Second, volatility dependency. If Nvidia's implied volatility drops, so does NVDY's yield. Third, tax complexity. Frequent distributions and options activity can complicate your tax return. And finally, no long-term compounding. Unlike growth ETFs, NVDY doesn't reinvest or grow its NAV meaningfully over time. Analyst forecast. According to StockScan.io, NVDY has a 12-month price target of $36.96, representing a 128% upside from current levels. Other forecasts range from $31.29 to $33.66, depending on Nvidia's performance and market volatility. Gov.Capital projects a 2026 price of $37.98 and a 2030 target of $374.71, though that's highly speculative. Bottom line, NVDY's future depends on Nvidia's price action, options premiums, and investor appetite for income over growth. Who should consider NVDY? NVDY is best suited for 1 point. Income-focused investors who want weekly cash flow to options traders who understand volatility. Short-term tactical allocators looking to monetize Nvidia's range-bound movement. It's not ideal for but 1. Long-term growth investors. 2. Those seeking full NVDA upside. 3. Passive index investors. Strategic outlook 2025 to 2028. Looking ahead, NVDY's success hinges on 1 point: Nvidia's sustained volatility. 2. Stable options premiums. 3. Investor demand for income ETFs. If Nvidia continues to dominate AI and semiconductors, NVDY could remain attractive. But if NVDA rallies hard or volatility collapses, NVDY's yield could shrink and price erosion may accelerate. By 2028, NVDY could either be a mainstay in income portfolios or a cautionary tale in derivatives-based investing. So is NVDY a smart way to earn income from Nvidia's volatility, or a risky bet with limited upside? Let me know your thoughts in the comments. Don't forget to like, subscribe, and hit the bell for more ETF breakdowns, option strategies, and long-term investing insights.